Similar to deposits, corporate lending products share some fundamentals with their retail banking counterparts, but have more complex layers added on top. First, just like consumers, corporations occasionally need to borrow capital to make big purchases. For this, corporate banks provide asset-based lending. These loans are backed up by some form of collateral, which the bank will take ownership of if the corporation defaults on the loan. This reduces risk for the bank and results in better terms and rates for the corporation. These terms are also impacted by the type of asset used as collateral. Banks prefer more liquid assets, such as marketable securities, as opposed to physical assets like inventory or equipment. Equipment financing and commercial real estate loans are common examples of asset-based lending. In addition to these large-scale purchases, corporations also have to manage a large number of small purchases made by their employees on a daily basis. For these, they turn to a different lending product: corporate credit cards. Like retail cards, these have an annual fee paid by the company and allow for spending up to a predefined credit limit. However, corporate cards frequently come with other administrative benefits, such as integrated expense reporting functionality and ability to aggregate and track expenditures across multiple individuals. Next, corporations also have to manage any cash shortages that emerge as a product of their working capital cycle. Costs are often due before revenues are collected. This time gap can leave a company in need of additional cash to sustain their operations. To help manage this, corporate banks may extend lines of credit to clients, allowing corporations to draw on them as needed, up to a specified amount, and then pay it off with interest in the future. Sometimes these are revolving lines of credit, which stay open on an ongoing basis, allowing corporations to borrow money repeatedly over time. Term loans and working capital loans function similarly, but have specified dollar amounts and payback periods. Companies can also engage in receivables financing or invoice financing, in which they borrow funds directly tied to invoices they are owed. Once these payments are received, the loan is paid off. Lastly, international trade creates unique financing needs for multinational corporations. To minimize their individual risks, exporters prefer payment before shipping goods, and importers prefer goods before making payments. Corporate banks help facilitate these transactions through trade financing products. One example are letters of credit. The importer will have their bank issue a letter guaranteeing payment to the exporter. Once the goods are shipped, the bank will pay the exporter, and once the goods are collected, the importer will pay the bank. Through a letter of credit, the corporate bank is providing a short-term loan to the buyer and taking on the transaction risk, but is also getting paid a premium for it. So far, we've discussed lending between a corporation and a single bank. In certain scenarios, a corporation may actually engage with multiple banks at once as part of a single lending transaction. This is called a syndicated loan and is used for exceptionally large loans, which would carry too much risk for any single bank.